Welcome to the Entrepreneur's Roadmap, a Clear Direction Advisors podcast. I'm your host, Kendra Vise, business strategist for service-based business owners who are ready to stop running their business on instinct and start building their business with intention. Every episode, we get into the practical side of growing and scaling a service business, the strategy, financial clarity, offers, team, and systems that it takes to build something sustainable. Now let's get into it. Most business owners look at their financial statements once a year, right? It's when they get them from their accountant and it's tax time. The rest of the year, they sit unread. Now, here's the thing. If that's you, you are not alone, but you're making decisions without the most useful tool that you have. And today we are going to change that. We're going to talk about what your numbers are actually telling you about your business and how to start using them to run your business with a lot more clarity and a lot less guesswork. So when we're talking about your financial statements, we're talking about, right, your P&L or profit and loss, maybe income statement. We're talking about your balance sheet, and we're talking about your cash flow. What you have to remember about your financial statements is that they are feedback on your business. They're past performance, not a judgment. So when we're talking about your P&L, we're talking about looking at a specific period of time and asking, is your business profitable? Looking at which offers are profitable and what are your expenses and are those expenses making sense? When we look at your balance sheet, it's looking at one specific day, right, in the history of your business. And are you building value or are you accumulating debt? Are clients paying you? What money do you owe? And cash flow is looking at how much cash you have and, can you actually pay your bills? If clients stopped paying you tomorrow, how many months can you actually go with the expenses that you have? You have to remember that the three statements work together and you can't just read one and think that you have the complete full picture of your business. And something else that I have to make very clear, because this is something that I've run across from multiple businesses over the years, profit and cash are not the same thing. You can have a profitable business and still run out of cash, which means that your business might shut down. So there was a business that I was working with, and on paper, they were profitable. Unfortunately, they had to shut down all operations because they were spending money that wasn't theirs. They were spending government remittances, source deductions, right? Sales taxes, income taxes. They didn't have a plan. They didn't set any money aside. And so when all of these obligations came due, the cash just wasn't there, right? So the money and your bank balance is not your profitability. And that's something that I know confuses a lot of people, is that if you look at your bank balance and if there's money there, you think that you're profitable and doing well, or if there's no money in the bank, you think your business isn't doing well, right? So you can actually have lots of cash in the bank, but you could be running a loss on paper. You could have absolutely no cash in the bank, and you might be highly profitable in your business. So again, cash and profitability are two completely different things. And this is why you want to look at all three of those financial statements in conjunction and certain pieces of it. And that's what we're going to be talking about today, because they each tell you something different about your business. Now, one of the things that I do with my clients is a monthly money check-in, right? So what this is looking at your financial statements at minimum once a month. You want to know your numbers. But of course, what is it that you want to look at, right? This is where, again, a lot of people, they look at maybe one or two things. They look at the bottom line. They really don't understand how those financial statements are, giving them information about the health of their business and how they can actually use that information to make decisions in their business. So some of the things that you're going to want to look at are things like revenue trends, offer profitability. Now, for service-based businesses, a lot of times the financial statements aren't set up to show you offer profitability. Might have to do some digging, or might have to set up your financial statements a little bit differently, or have a dashboard that's showing you this. You also want to take a look at the net income. That bottom line really is important, right? You do want to look at your cash reserves, how much cash you have, what money is going to be coming in and when you can reasonably expect it. You want to see what money is going out and when you're going to have to pay it. And of course, when you're looking at things like cash flow, you also want to make sure that you understand when you might have annual obligations, right? Or quarterly obligations. So these might be things like subscriptions that come out once a year, income taxes that you have to pay once a year. Could be things like, quarterly sales taxes that you have to pay or monthly. But also things like you have to pay your employees, you have to pay your subcontractors, your freelancers, right? So what money is going out? Now, you really need to understand that your financial statements are not there to judge, right? And you shouldn't be judging yourself by what you see. It's about understanding what's going on in your business so that you can make better business decisions. And I'm not saying that you have to be an accountant. This is where you need to work with your bookkeeper and your accountant so that you can have the statements set up in such a way that it makes it easy for you to do this monthly check-in and make sure that you do have an understanding of the financial health of your business. So you don't have to be an accountant, you don't have to have an accounting degree, but you do need to be consistent at looking at these numbers. The other thing that I work with my clients on and that business owners need to understand is that your financials are just one piece and one part of the puzzle. It's not the entire picture of your business. You also want to start to take a look at some of the other numbers, and this is where having things set up in such a way so that you can take in that monthly check-in is really, really good, but you might have to pull some things from beyond the financial statements, right? One of the things you need to look at is capacity. So how much client work can your team actually do? Do you know that? Because if you don't know that, when you're setting your goals, it's going to become very difficult to set realistic goals if you don't understand the capacity of your team. Productivity comes in there as well. Because if you don't know how productive your team is and where the inefficiencies are, it's going to be, again, very difficult to take a look at what are some realistic goals. Because if you've got, somebody who's highly productive versus someone who's maybe not as productive, right? You need to know that because, again, productivity and capacity go hand in hand. And you need to understand that when we're talking about what is the health of your business. And again, goal setting that comes into play immensely, because I've worked with clients where we were setting goals and we were taking a look at what their revenue goals were, and we were taking a look at what was the offer makeup going to be, how were they going to actually deliver these services. But when we started to dig into the capacity and the productivity, we realized that in order for them to reach those revenue goals with things the way they were right now, without any changes, it actually meant working way more than they or their team wanted. It just wasn't going to be actually possible because they didn't have the systems in place or the people in place, right? So instead of working 35 hours a week, in order to reach those revenue goals with the capacity and productivity levels that they had, it was going to be 50, 60, 70, 80 hours. Very unsustainable, right? Not going to happen at all. But that gives us numbers, right? It gives us information. It gives us data to work with in order to set realistic goals, but also to start digging in and going, what do we need to do to be able to hit those revenue goals? But it also allows us to start digging into things like the profitability per offer, right? Now, again, service providers, a lot of times this isn't actually going to be set up in your P&L simply because most wage expenses, those costs for your staff, are going to be put into just general expenses. And it's completely right, accounting friendly, the way that it's been, and that's fine. But when you're actually trying to make business decisions, you do need to understand the profitability per offer. Because if your offers themselves aren't profitable, then you need to adjust those offers. You need to either increase your pricing, you need to either increase the efficiency of delivering those offers, right? Or maybe you need to drop the offer completely. Or if it is just breaking even, but it is right, sort of that start of the client journey, start of the funnel of them working with you, maybe you're putting it in and you're saying, I'm okay with it being break even. We're not making a lot of money on this, but it's allowing people to understand how to work with us, what it is that we do, how it is that we're doing that. And it's the first step of them working with you to build up to other offers. And that's fine as well. I'm not saying necessarily to get rid of offers, but if they're costing you money, right, if they're not profitable, then absolutely something has to change. Either they have to go, they have to become more efficient on delivering them, or you need to increase your prices. So this is something that I work a lot with my clients on, is making sure that they do actually have an idea of what their profitability per offer is. And depending on, right, what it is that they do, in some cases, based on the industry and the business, we're going into the product or project profitability, right? So sometimes we actually have to do a little bit of digging, or we have to set up a secondary report and dashboard that goes into that monthly check-in that they're doing with their numbers, but it is giving them that profitability. Other numbers that you really want to understand is the client acquisition cost. Big fancy name, basically, for what does it cost you, both money and time, to bring in a new client. If it is costing you more than that client is worth, then again, that gives us some very valuable information. And what we need to do is understand what it is that's taking so much time to bring that client in, right? And potentially money, right? Because time is money, but also if you're spending marketing dollars, or you're paying staff members to do things, right? There's also the sales calls, all of that goes into it. And if you're spending, right, $1,000 to bring in a client that's worth 500, that's not worth it. It's not sustainable over the long run. If you're spending $1,000 to bring in a $10,000 client, then absolutely that cost to bring in the client was worth it. And sometimes this is things where we need to look at the bigger picture, right? Maybe something costs you $1,000, but over time it's bringing you in multiple clients of 500. Then at some point it makes sense, as long as that $1,000 isn't repeating every month. And in with that client acquisition cost is the ROI, or return on investment, for marketing spend, right? So if you're, again, spending money on advertising, and that's right, it's costing you money, it's cost you time to set up those advertisements, what clients is it actually bringing in? And that's fine as long as you understand it. And sometimes you also have to understand there's an accumulative effect there, right? So people need lots of times of seeing your name, seeing, right, your business, seeing what it is that you do. And so sometimes you can't just sort of set up a marketing spend and go, oh, I'm going to test it for a week and we're done. It didn't work. Just like when we're tweaking messages and offers, you have to give it time to actually work. But if you're spending on marketing and you're not getting any return on it, again, we need to start looking into and going, is this actually worth it? Not only in the short term, but in the long term. Now, some people sit there and go, well, why do I need to dig into my financials? I know my taxes. I'm good with that. It really does come down to it gives you such valuable information. Even if we need to start digging in behind those numbers, which a lot of times we do, but it helps you again with goal setting. It helps you with capacity planning. It helps you with productivity. It helps you make business decisions. So I was working with somebody, they had what they thought was a very ambitious revenue goal, right? They were expecting this to take 18 months to 2 years to hit this revenue goal. And they had, an idea of what it was going to cost for, right, to deliver these services in order to bring in the revenue and what, they wanted to have for take home pay. We sat down, we did some forecasting, and we built out their weighted pipeline. So we were looking at what deals that they actually already had that were already going, what deals were coming down the pipeline, and where they were at. Was it, 95% we were just waiting for, a signed contract, or maybe the signed contract was there and now we were just waiting for them, right, to get started, or they were sort of in the process and about 50% through, and then we sort of said, how much do you actually think this is going to go, right? So weighted pipeline, looking at the probability of each deal closing and what the value of that is. So when we did that, came back to them and said, hey, you need to make a new revenue goal. But it's not because your revenue goal was too high. It's because you're going to hit that revenue goal within 12 months. Based on the information that we have, you're there, right? You're going to be making the revenue that you wanted. You're going to be making the income that you wanted, because when we did our forecast, we included all of that. What is the cost for delivery? And this was going to be what you wanted to take home from the business. You were going to be able to do that, and you were still going to have money left over. So let's make a more ambitious revenue goal. But if we hadn't done that and dug into those numbers, they wouldn't have known. But it also gave them the information that they were going to need to hire sooner than they thought, right? Because they were going to be having these new deals coming into play, they were actually going to have to hire people to be able to deliver. If we hadn't done that and they didn't know to keep an eye on it, they might have waited way too long to hire somebody, and now they would have had a hard time actually, right, fulfilling those contracts. So this is what happens when you actually start combining those numbers and taking a look at what you need to make decisions, right? It's the financial statements, absolutely, but it's looking at your sales pipeline, it's looking at your capacity, your close rates, and your costs to deliver. It helps you make decisions, and it actually helps you figure out which decisions and where your priorities have to be, because it's starting to make them obvious. Just like going, hey, these deals close, you're going to need people here in order to fulfill those contracts. You stop guessing when you have the information you need to make the decisions. So when we're digging into this and we're looking at your numbers, what are some of the decisions it's going to help you make? Well, hiring is one, right? Do you have the work for somebody that you want to hire? But also, do you have the cash flow to hire them? And then it's also, what is that role going to be? And where does it add capacity for you, for you and your team to be able to free you or someone else on your team up to do something else? When it's taught, we can look at pricing, right? So we can look at, okay, so if we're increasing prices by, X percentage or this many dollars, what is that actually going to do to the profitability, right? How does that help your capacities? What can where can you reinvest? Can you now, if you've increased your pricing, does that mean that now you're going to be able to bring that new hire in faster, which is going to give you more capacity, right? Or is it going to allow you to invest in better systems? Is it going to allow you to invest in systems that are going to give you better efficiencies? It's going to let us dig into your marketing spend, right? Is the marketing spend that you're doing Is it actually working to bring in, right, discovery calls, to bring in actual paying clients? What's the return on the marketing spend? How much is it helping? It's also when we're starting to look at things like expenses and that is looking at the systems. Are you duplicating software? If you've got software that's essentially doing the exact same thing and you're not utilizing software and you're, trying to bring in ad hoc pieces, but you're duplicating systems, is that worth it? Is it worth it from a time perspective? Is it worth it from a money perspective? Because every time you duplicate a piece of software, there is an actual money cost, money going out the door. Do you really need to be spending that? But it also then, if you start to see duplicate software, duplicate systems, then the other question is your team actually using what you've set up? If they're not using it, again, is that a good spend or not? So an example of this is, right, people that I've worked with and clients that I've worked with, where they are looking at new systems in order to be able to do project tracking better, right? And it's incredibly important. We don't want anything to fall through the cracks. And as you're adding clients and, working with more people, adding team members, you absolutely want to make sure nothing falls through the cracks. But they've been sort of adding systems in that ad hoc way. They've got one system over here for this offer, another system over here for this offer. And they're looking at another system to, okay, well, maybe if we get this one, the original system that they have, though, can do everything that they want. They've just never spent the time to set it up. So now it's is that system that they currently have, they're currently paying, their team is using for one offer. Can we set that up so that it's actually going to work for them as a whole for their business rather than going out and trying to ad hoc things in, right? Or do we just get rid of all of the systems that they have and bring in something new? That's what happens when you're looking at this and going, hey, my numbers are showing I'm spending things, spending money on multiple pieces of software that essentially are doing the same thing. One of the last things that your numbers are going to tell you, right, is your goals, or are your goals realistic? Right? Are your revenue goals realistic based on the capacity that you currently have and your offer pricing? Right? It's really, really important, because if you're going to set yourself up with a unrealistic revenue goal, you're going to fail. Not because you're not capable of it, but because you and your team don't have the capacity to bring on enough clients to make that revenue happen. But it's also looking at the offer mix of what you're planning on selling and all of that, and going, is this, again, reasonable with the capacity and the prices that we have? And not only the revenue goals, but we need to start looking in, right, the profitability goals, the net income, and the take home pay. So final thoughts on the numbers, because I know numbers are scary for a lot of people, but your numbers are not there to judge you. They simply exist. They are there to be used as a tool to make decisions. That's what you need to be using them as, right? You don't need to be a bookkeeper. You don't need to be an accountant. But what you do need is that trusted person, bookkeeper, accountant, advisor, someone who you can lean on and have them help you set up a system where at least once a month, right, you sit down, look at the numbers, and actually understand what they're telling you. And it's making sure that whoever's helping you set up those numbers and setting up those dashboards and setting up those reports are giving you those things that are actually going to help you make decisions. You've got the right metrics in there so that you are actually, using factual data to make decisions, not gut feeling. Basing on gut feeling is not a business strategy, and it's not a way to build a sustainable, growing, scaling business. You need actual data. Now, that's it for today's episode of the Entrepreneur's Roadmap. I want you to remember your numbers are not there to judge you. They are not good. They are not bad. They simply exist. They are giving you valuable information about your business. So when you understand them, they stop being something to avoid and stop being something to be scared of. They start becoming one of the most useful tools that you have to make business decisions. So what I want you to do this week is pull up your financial statements. Just look at them. Start getting comfortable with what you're looking at. And if you have questions about your seeing, that's exactly what a discovery call with me is about. The link is in the show notes. Until next time, see you on the road.